All right, guys, bang, bang. Super excited to have Brooke on. Thank you so much for doing this.
Yeah, it's my pleasure. Thanks, Anthony, for having me.
For sure. So let's start with your background. Before you decided to go out on your own and start Hut Capital, what did you do?
So before Hut Capital, I spent 10 years, I guess you might say, in the institutional LP world. So I started my career working here in Portland, Oregon for a family office consultant. And yeah, it's a consultant that helps wealthy families with their investments overall and building their portfolio and generational wealth and all the things you would think of. But specifically, I worked on the private markets team. So our team helped these families to invest in private funds. And that was effectively anything that was illiquid, not a hedge fund. So we were investing in buyouts, growth equity, venture, credit, real estate, energy, timber, a whole host of private strategies, a pretty broad world. Did that for a while and then actually moved out to the East Coast for a few years, first in Philadelphia with a firm called Hamilton Lane, which is now a public company, but it's a massive private equity advisory and asset management firm based in Philadelphia. And similar model on the advisory side, except their clients are more like big pension, sovereign wealth funds. So they have a very large asset base because of that. And they also have a large discretionary business. So they manage fund to funds vehicles, co-investment vehicles, where they're investing in directly in companies alongside some of their managers, as well as secondary vehicles. And in particular, I focused on secondaries there. So we managed a fund that would buy out limited partners in different types of private funds. We would help GPs to restructure their funds, give them additional runway, help captive venture and private equity funds to spin out, become independent. And this was when Dodd-Frank was really taking effect in terms of a lot of financial service firms, basically having to get rid of their venture arms or private equity arms. So we're involved in some things on that side of things. And basically anything where you're buying an existing portfolio of private assets, managed by a third party. And did that for a couple of years, and then had the good fortune to join a firm called Greenspring Associates, which is now over a $10 billion venture platform. And their model, it's all venture capital, fund to funds, secondaries, and directs. So they have a number of different vehicles, but generally speaking, spent my time investing in venture funds, and that was funds like Benchmark and Excel and Bessemer and Foundry and folks like that, and then a lot of emerging managers, folks like Pear Ventures or Pioneer Square Ventures up in Seattle. So really kind of the full gamut as well as internationally. On the secondary side, we were buying limited partnership interests, as I mentioned earlier, as well as direct secondaries, so buying stock from founders, early employees, management, whoever it might be, but buying common stock from folks like that. And then also just doing very traditional growth stage direct venture. So it was kind of Series B and later. We were leading rounds, very very involved post investment. So much more of a true venture strategy versus co-investment strategy, like you might assume, given the fund to funds model. So did that for a few years, and in particular helped to build out their secondary business as well. And last year I was there, spearhead their efforts in the blockchain space, and we can go more into that if you'd like, but as you might imagine, that's what led to starting Hut Capital.
Yeah, and so I want to talk a lot about like the process you use, right? You've sat in the seat multiple times at multiple firms, so you kind of seen how many people do this. But one of the things when you're sitting in that kind of institutional LP seat is there's people who have trusted you with their capital and are relying on you to deploy capital, but you're really doing the work of sourcing, vetting, and ultimately deciding or recommending, hey, this fund over another fund. And so maybe walk me through, like, what does that due diligence process look like? And then we can get into some of the intricacies as to, where people kind of stumble and where people thrive. But what does the process of due diligence look like when evaluating fund managers?
Yeah, so it's a very qualitative process. Unlike maybe I don't know, maybe hedge fund investing, which is maybe much more quantitative, but it's a very relationship driven business overall. If you just think about the world of venture capital, because these are people you're going to be partnering with for 10 to 15 years. So just, getting to know people, making sure these are people that you're going to, want to work with over, a very long period of time is kind of an important first step in just getting to know these folks. From a quantitative perspective, before kind of getting to more of the qualitative assessment, there is some work you can do, and in particular, that comes down to analyzing the track record and cutting it a lot of different ways. So looking at, okay, every deal they've done, look at it by partner, look at it by geography, look at it by sector, look at it by stage, kind of all the different ways that you could cut the data and, see what trends you can find from that. So, maybe you see that there's one partner who's really driving all the returns. Maybe there's one geography that they're really horrible at and they clearly just need to stop investing in or, whatever that data tells you, and look at, okay, well, how does that relate to their strategy going forward? Is that partner who has really driven historical returns retiring or whatever it might be, or maybe they're taking a bigger role and that's a great thing. And, trying to draw conclusions from that, and then, using that to assess how their strategy is going forwards, and, hopefully, that it's kind of supports their continued strategy. Or, maybe that just leads to certain questions around, like attribution, for example, and like, oh, look at this partner who's not there anymore, and somehow they are attributed all the bad deals. Like that's kind of a little questionable. So it tells you a lot from that perspective. But generally speaking, it is much more qualitative, right? So you need to dig in, understand their strategy, what's their approach, what's their process to doing investments, how are they sourcing deals, how are they working with companies to, as a board member and, helping to, provide value post-investment. And it was, generally speaking, like who are the most sought after VCs by founders? Who's seen the best deal flow? Who do, founders really want to work with, and, kind of top founders that you would want to have access to. And, how do they differentiate themselves in the market? Why are founders going to choose them versus anybody else? A lot of that stuff, which is, you just learn through conversation, is very important. And then there's also, the operational side, right? So what does the firm look like? What does the team look like? What does the organization look like? Are you comfortable with them? Their ability to run a firm and run a business and build a team and bring on talent. And, all of that is very important, including, back office and, a lot of kind of the more, less sexy but important operational things. I guess one other key thing is portfolio construction. So, generally speaking, I certainly have a preference, for example, I'd say most LPs do, for, slightly more concentrated portfolios versus like a broad spray and pray approach. And, how many deals are you going to be doing? How do you think about reserves, for example? And, you see that as a big issue with a lot of first-time funds, where they don't realize they need to keep a lot of reserves to continue backing these companies, and they end up with, very small ownership, and, they don't have the ability to keep investing in their best deals. What kind of ownership are they targeting? Just kind of how are they planning on allocating the portfolio in different ways like that?
And it seems like it's this weird balance between when you first go in to do the due diligence, you're really kind of a detective, right? You're trying to understand what's good, what's not. But then once you say, hey, this is somebody that we want to invest in, at times you almost have to become a salesman now, right? Now you've got to convince them to actually take your capital. And so how do you kind of experience that balance between you want to be able to do the diligence that you want, and sometimes that requires hard questions, uncomfortable conversations, kind of asking for introductions to people that you can go do reference calls with, like all of the things that generally take work and time and effort. But then at some point you want to turn around and be like, hey, we're going to be a really easy LP, right? And you should take our money. It's like, how do you kind of balance that?
Yeah, so I think it really comes down to the relationship that you build with these folks, and not just being, oh, we have this LP who gets our quarterly report and, they come to our annual meeting, but we don't really know them, but really building like a true personal relationship with the GPs that you're investing in. And, that helps in a ton of ways, just in terms of, they're being open to you asking tough questions, and, kind of the ability to increase allocation to, top funds in the future and stuff like that. Sorry, can you repeat the question again?
Yeah. So just like, how do you basically balance between, being overly kind of investigative on the due diligence process, but then also at the back end being able to, convince them to take your money over maybe another LPs?
Yeah, so I mean, I think GPs generally understand you need to go through your diligence. Like, just because you're having a conversation about the fund, that does not mean you're going to invest in the fund. It's just kind of the process of diligence. And Honestly, sometimes you do that. You go through your diligence, you end up with a negative assessment, and the GPs are not pleased with it. And I think that kind of tells you something when that happens. But yeah, I mean, really comes down to the relationship, and if if you build strong relationship with these folks, they're much more likely to be helpful for you, to want to make introductions for you, to help you with direct investments, for example, and just kind of help you out in different ways. And also about what I mentioned about being being a passive LP, like people want LPs who are going to provide value to them as well. So like providing feedback, sitting on LP advisory boards, helping them with LP introductions, even providing them with deal flow when you see it and stuff like that, and finding different ways to provide value as an LP. And I think, if you build that relationship, if you're providing value as an LP, like the idea of convincing them to take your money becomes a lot easier, because you're not just any other passive LP, but you're like a real partner for them. And, there's someone that they really value having as an LP, they want to have as an LP. And then, the kind of sales process, while, that is always a part of it for, really hard to access funds, becomes a lot easier, because they can really see that it's important to you and that you'd be a great partner for them. And I've definitely been on both sides of that. In my prior experience, I've been at places where we lost access to really good funds because we didn't properly build those relationships, and we were not an ideal LP in certain situations. And then I've also been on the other side of that, like a Greenspring, for example, where they focus very strongly on those partnerships. And, I've seen how that can really, really provide value as an LP, and, kind of increasing your allocations with really hard to access funds over time.
Yeah, that's awesome. And I guess, what are like the major points where you see fund managers fail the due diligence process? Like, is there one or two things that you're like, these are just the most common mistakes that people make?
So yeah, a couple things. I mean, one, you have to have a certain level of confidence that they can be successful in what they're doing based on past history, right? So for a lot of first-time funds, and often it's not they're not at fault for this. It's just kind of inherent in in the process. They don't have the proper investment experience or track record, or the ability to say, hey, I've done this in the past, I can continue doing this, and here's the proof of that, right? So that's often an issue. I'd say another thing is just differentiation, right? I mean, there's literally over 1,000 early stage venture funds out there, and I mean, if you're an LP, you just have your choice of so many funds. You really have to figure out, how are you differentiating yourselves? Why should I be paying attention to this fund versus the 1,000 other funds that are coming and talking to me? Why do you stand out? Why are you going to get better deal flow? And you really have to be able to like tell that story and make that very clear in an initial conversation, so that when people come away from that, like, oh, this is really interesting, I think this really stands out. And kind of just that like standing out from the crowd, given how busy LPs are, how many funds they're seeing, is really important, just in terms of getting kind of second conversation and progressing that conversation forward. Obviously from a track record perspective, there are definitely funds that have done well without, frankly, having an amazing track record. But I'd say for the most sophisticated LPs, having that good track record, and being able to dig into that and say, hey, you've been very successful in doing that, obviously is a key thing. And there are certain things that specific LPs look for. Maybe it's like they don't like having single GPs, or other kind of specific criteria like that, where maybe it's just a small fund and they don't want to be above a certain percent of the fund, which similarly managers can't necessarily do things about. But there are certain kind of criteria like that LPs look for as well, which can kind of be a negative signal.
Yeah, makes sense. And then I guess, what have you seen maybe the best fund managers, right? So kind of the top 1%, what do they do that separates them in the eyes of institutional LPs from even the ones who are really, really good? So like the kind of 5 best in the world from everyone else, what separates them?
Aside from just having the brand, having the reputation, kind of the typical stuff you would expect, I'd say one big piece of it is just building like a lasting, repeatable institution. So, there are plenty of good investors out there, and a lot of groups who like, okay, I'm going to do this for a couple funds, and then I'm going to retire or whatever it might be. But I think LPs are looking for, and the top funds are end up being these long-lasting institutions that can weather generational transition and really, really building out for the long term. So firms like, ones I mentioned earlier, like Benchmark and Excel and Bessemer, they'd all been around for a long time. They've gone through generational transition. They've continued to be a sought after partner for LPs. And, that's not an easy process. You've also seen firms that have, I guess I don't want to name certain names, but have not done well with that. Where, they've had these amazing brands, and then that brand has really declined, whether it's maybe bad performance or they haven't been able to continue to build out the team, continue to build out new talent, and have people want to come there. So I think that's kind of a underrated but very important piece of it.
Yeah, and so you at some point decided, hey, I'm going to leave and go kind of full on into blockchain, and also start your own organization. So maybe
Mhm.
talk us through, like, what was the accelerant for wanting to do that, and ultimately deciding to.
Yeah, so for some background, I guess, and how that came to be. I'd been tracking the space for a while prior to Capital, and I went to school with a couple of guys who were early in the space, and we graduated before Bitcoin existed, but they were doing some interesting stuff later on. It caught my attention. They were doing well, and yeah. To be honest, though, at first I didn't fully dig into it. I certainly dismissed it a little, but then I started Greenspring mid 2014. So I started doing venture full time, and that space started becoming a little more relevant for my day job. So I remember catching up with one of those folks, and I think this is late 2014, and walking me through how they use their platform, and just moving crypto around. For example, I was just kind of blown away by how easy it was, and how just how smooth and seamless it was. And I remember sending a note out to the full team at the time, and it's like, hey, we should be tracking this company. This is really interesting. And I didn't get a single response, which was kind of a sign of the times. But I was paying more and more attention to that space as I was doing venture full time. But the problem is it wasn't at all relevant for my day job. So that really changed in 2017. We started seeing a lot of these dedicated blockchain venture funds emerge. You had a couple that had been around for longer, but we saw a much larger in terms of fund size and number of managers and quality of those managers. And so I went out and was like, all right, I'm going to go out, get to know all these funds, build those relationships, just build relationships within the space more broadly. Spend a lot more time in education. And so went out there and did that, and that led to spearheading Greenspring's efforts in the space, as I alluded to earlier. And Greenspring, it wasn't a key focus for them, and I got to the point where I wanted to spend my full time and attention on it. And really felt at Greenspring we had a pretty broad purview into all things venture, between the fund of funds and the direct investments and whatnot. And I just really felt like if you looked at where a lot of the innovation and venture returns had come from for the prior 10 to 15 years, areas like software and e-commerce and marketplaces and on-demand and stuff like that. Yeah, I feel like a lot of that was somewhat played out, and opportunities becoming more niche, and much more saturated competitive market, obviously, which has also been flush with a lot of capital. And so I was looking at, like, okay, where is real innovation going to come from over the next 10 to 15 years? Where do I want to spend my time? Where are true venture returns going to come from? And came to the conclusion that blockchain and crypto was that space. Unfortunately, couldn't spend my full time and attention on it at Greenspring, so left to start at Capital, which we can go more into if you want, but is effectively taking Greenspring's model and applying to the blockchain space. So it's a venture fund funds and direct investment firm focused on blockchain VC.
Got it. And so help me understand, like, what is the argument for fund to funds versus going direct to managers for investors? So people that you go talk to and say, hey, you should work with us, versus go to a direct manager. What's kind of that pitch look like?
Yeah, so I guess to provide some background just on fund of funds in general, to give context maybe. So I mean, the fund of funds idea has been around, I guess, since the 90s. So it's a model that's been around for a long time. And it really started as more like I guess you could call it traditional fund of funds. So folks that were giving you access to a lot of like buyout funds and kind of general private equity. It's like, hey, you don't know this space very well. Come give us your money. You can just make one commitment and get broad exposure to the space, and you don't have to worry about it. And, that became a pretty popular model. You've seen a lot of, kind of pretty sizable businesses built around that over time. But as LPs have become more and more sophisticated and, do more and more of this in-house, and just, private equity's been around for longer, that expertise and relationships and access are important. So areas like, venture capital, or small buyouts, for example, or international, like, if you're sitting here in the US investing in China and emerging frontier markets is often difficult. So, you've really seen fund of funds thrive in areas like that. And, so why would you use a fund of funds in venture capital or in blockchain VC, for example? So, there's a couple of reasons, and depends on what kind of LP you are. For smaller LPs or, smaller teams, I mean, it really just comes down to, bandwidth and efficiency, right? So if you're a smaller investor, does it really make sense to write, 5 or 10 even smaller checks? Probably is not a feasible thing. For other LPs in general, I think folks in a space like this really value the diversified model, and saying, hey, I can make one commitment, get exposure to, let's say, 10 funds. And, especially in a space like blockchain venture, I think having exposure to different parts of the market is very important. So, different structures, different views on the market, different geographies, different structures. And, it's often, difficult for people to take the time, okay, I'm going to spend, whatever, significant amount of time is required to, really dig into the space, get to know all those funds, make those assessments, and, end up making, a handful of commitments. And it's just much more efficient to outsource that to someone who has the expertise, has relationships, has the inside baseball on the market and the funds, and the ability to really do a lot of referencing, not just the ones they ask you to, who are all going to say good things, but have the network within the space to really dig around and get to the bottom of what's going on. So there's a handful of different reasons, and I think over time, as this space kind of progresses, you'll see what you see in the traditional venture space, which is access also becomes a key thing, right? Because if you're an LP in Sequoia or Benchmark or Greylock or whoever, that's not something that's really repeatable. So if you're a new LP coming into the space, having access to these funds that are impossible to access is also a key differentiator, and being able to provide that access to LPs is obviously a highly valued resource.
Yeah, makes sense. And I guess, how do you look at kind of the blockchain fund landscape, right? Meaning that, first of all, are you looking at just VC, or are you looking at kind of the entire landscape, even liquid traded funds, et cetera? And then inside of the blockchain fund space, like, how do you think about that difference between structures and strategies?
Yeah, so I guess when we look at the blockchain VC landscape, we're focused specifically on what we focus out at Hook Capital, which is only closed-end venture funds that are focused on blockchain. So excludes hedge funds, excludes hybrid funds as they're called, and I could get more into that. But these are all closed-end venture funds, and that universe, I think we're currently tracking 66 or 67 funds that meet that criteria globally. So I think it's a lot more than people realize. There are quite a number of funds out there. What that landscape looks like, though, is it's about 70% US. So in terms of location of those funds, certainly the majority are in the US. The other 30% are, generally speaking, split between Europe and Asia. And the landscape overall, I mean, it's a landscape of emerging managers, right? Most of these funds haven't been around for very long. I mean, the oldest funds have only been around for maybe 6 years, which, for a venture fund really isn't that long. So, you just don't have, kind of these, legacy institutions that have been in this space for a long time. Everyone's effectively an emerging manager, which, also kind of, to the fund of funds point, increases the value proposition there, since selection risk is really high when you can't look at a 10, 15-year track record. And overall, if you look at the total amount that these funds are either have raised or are trying to raise, if they're raising right now, that number is about 4.2 billion, which probably sounds like a lot of money, but relative to the overall VC landscape, it's like nothing. It's a very, very small amount on a relative basis. So, there is a fair amount of money, being raised by these venture funds, but it's a very, very small piece of their overall venture landscape. Um, so yeah.
And as part of that, like when you look into the different structures or VC funds, right? It sounds like most of the structures all actually line up for the most part. On the manager side, like, do you see the emergence now of pre-seed, seed, kind of Series A, Series B, growth stage? Kind of the mirroring of what you see outside of the blockchain landscape and venture, or is it still so early that you're actually getting firms that are kind of playing at all of the stack, mainly out of necessity because the companies need their capital and their backing?
Yeah, so I guess for quick context before answering that directly, most of the closed-end venture funds are investing a majority in equity. I say most also do, not all, but most also do some level of token investing, but it's generally speaking, a smaller piece of what they do. And on the token side, that tends to be very early stage in nature, because while those are still private, inherently they're kind of more like the equivalent of seed stage. But on the equity side specifically, you definitely see the exact same exact same things you see in the traditional venture world, where you have the same series of rounds: pre-seed, seed, Series A, Series B, or whatever it might be for a specific company. And in terms of the venture fund's focus, it really started where basically everyone was a seed fund, right? Because if you look a few years back, I mean, that was where you were investing by, just inherently as an investor in this space. And you've really seen that evolve, especially in the past 2 or 3 years, where there's much more of a bifurcation now. And I'd say it's largely driven by fund size. So you have, a handful of funds that are on the larger end of the spectrum, and those are kind of acting, while they'll still do some seed investing like most larger venture funds would. They're really, most of the capital is going to more like traditional Series A rounds. Maybe there's a Series B mixed in there, whatever it might be, but you kind of think of those as like your traditional Series A investors. I'd say the bigger portion of the market and most of the smaller funds are, seed, pre-seed investors. But you definitely are starting to see that bifurcation, and especially as some of the larger funds have moved up market in terms of fund size over the past couple of years. There's been an interesting opportunity for new funds to basically fill that gap at the pre-seed and seed level and establish them as kind of next gen firms, I guess you could say, at that part of the market.
Got it. And then how do you think about kind of the blockchain funds interacting with the traditional venture funds, right? Meaning that if you've got most of the blockchain focused funds being kind of seed, pre-seed, maybe even up to Series A, obviously those companies are going to need large amounts of capital later in the stage of development. And so you're going to have to rely on non-blockchain focused funds, at least right now, to kind of continue to fund those businesses. And so do you do anything in terms of understanding kind of the relationships between traditional venture funds and the early stage blockchain funds, or just how do you think about that kind of interaction there?
Yeah, I mean, I wouldn't say it's a key part of our focus from a diligence perspective in terms of like specifically what are those relationships. I mean, it often does come up during diligence, just given a lot of the groups that they're co-investing with in their existing portfolios, for example. But I would say that it is something that we pay attention to in general for really Series B and later, because you have plenty of funds that are doing seed investing and Series A investing, but generally speaking, the funds in this space are pretty small. It's not like you have NEA who has $3 billion or whatever it is, and they can continue to fund companies forever. They are clearly reliant on outside investors to continue leading future rounds, Series B, Series C, Series D. So, I'd say, given there aren't a ton of companies that are later stage in this space, it's still kind of TBD in terms of exactly how that plays out. I do think, they will be reliant on generalist firms. There aren't any, sizable, or maybe at all, but sizable later stage venture funds dedicated to this space. So, looking at funding rounds for some of the companies that have raised like Series B rounds, for example, recently, I haven't seen the issue raising capital, but it is definitely something that is a potential concern we're watching closely going forward.
Got it. And then I guess another piece of this is you also mentioned that you guys may do some direct investing. Maybe explain a little bit about what you guys would do there.
Yeah, so I mean, to the earlier conversation around kind of the fund of funds model, another, I'd say, important development in the fund of funds world is that you can't really just be a fund of funds anymore. So, the groups that have been most successful have effectively built platforms around the fund of funds. And if you think about what the fund of funds model is, you're an LP and a bunch of underlying funds. You have access to all sorts of very unique, non-public information on the underlying portfolios. You have access to board members of these companies. You just have very unique access to in terms of relationships and information. And if you're thinking about how can we utilize that for the benefit of our LPs, clearly the key answer to that is doing direct investing. And in particular for us, so we're not competing with our early stage managers. We don't do early stage investing. That's much harder, and we leave that to our partners. But what we look to do is track their portfolio companies, and then effectively try to invest in their best companies once they're really Series B and later. And we only do equity, so we're not making any token investments. But that could be anywhere from doing a Series B round with a few million of revenue on the early side, all the way through buying pre-IPO secondaries and everything in between. And also to the earlier conversation around the relationships you build with these funds. We don't ask for co-investment rights, for example, right? Everything we do is just built off of the relationships we have with these GPs and the information we have, and having them want to help us on deals, and just having that kind of be a regular part of the dialogue, right? So I think that's a much better approach than trying to structure it where they're forced to give you co-investment. And we're also not co-investing per se. We're kind of coming in, I guess technically after our early stage managers would. But yeah, so that's part of our focus as well. And we'll also find other ways to create value based on relationships and information we have, whether that's buying LP secondaries. That could potentially be buying GP stakes in underlying funds. And just looking for different ways that we can use our position to our advantage and for our LPs.
For sure. And then talk to me a little bit about your interactions with founders. Obviously, on the direct investing side, that may come up some, but also on the due diligence side, right, of kind of diligencing the managers themselves. Kind of what does that relationship look like, and kind of how do you normally go about those conversations?
Yeah, it's a good question. So it is definitely an important part of diligence, and typically as part of that, you will talk to portfolio company CEOs. So typically they'll give you a reference list, and it'll have some number of names on it. So those are good people to talk to. Obviously, you're going to assume they're going to be positive, but it's important to talk to those folks and get their perspective. It's also important to talk to people who aren't on that list. And to your earlier comment around being an easy LP, you don't want to just call all their CEOs and clearly disrupt business from that perspective. But it is important that you talk to folks and figure out who would be good to talk to, who is not on that list. Or maybe it's instead of just talking to the 3 CEOs who are their best portfolio companies, also talking to ones who have been have not done as well, and seeing how they served as a partner through that process of things not going well, right? That's obviously very important as well. So, in terms of what you talk to them about, I mean, it's typically, where did the relationship come from? How did you get to know that person? How did they get interested in the company? Why did you choose to work for them, or why did you choose to work with them, and choose them as a partner? Was it because they just gave you the highest price, or, was it because you really valued them as a partner? Maybe it was a pre-existing relationship. And, maybe you went with them even though they weren't the best price. How have they been like to work with, post-investment? What's the cadence of communication look like? How are they as a board member, whatever that might be, just generally, how are they viewed by founders in the space? And just kind of really digging into that relationship and figuring out, why did they choose to work with them? How did they get access to the deal? What they've been like to work with post-investment, and kind of what's their reputation amongst founders.
Yeah, it's really interesting. And then I guess before we finish up, I want to talk about your LPs, right, and kind of the conversations you're having on that end. So you go out, you talk to people, they give you money, and then you go make these investments we've been talking about. But like, what is that environment been like as you talk to investors? Kind of let's talk maybe pre-pandemic and then post the start of the pandemic. Kind of what's changed? What are you kind of hearing, and what does it look like?
Yeah, so I mean, pre-pandemic, I'd say trend-wise, things were good in terms of LPs being increasingly interested in this space, and generally just being much more educated going into conversations. So if you compare it to a couple of years ago, like the level of education, generally speaking, that we have to do in a meeting is much less than it was 2 years ago, and it's much more about what's our focus, et cetera, rather than what's blockchain, what's crypto. So that's been a really good development, and I think for a lot of groups it's just been a very long education process, especially on the institutional side. And they have to get up to speed, and then they have to convince their their team and then their board and whatnot to actually allocate capital. So that's a long process, and it's been good to see institutions kind of get go through that process and kind of closer to allocating capital, broadly speaking. Definitely when the pandemic hit, let's say back in March, you saw a lot of folks basically just go on hold, like, okay, the market's down 20% over the past couple of weeks. We need to kind of just put the brakes on here and see what's happening. For large institutions where they were looking at this space, but maybe it wasn't like a true priority. It was just kind of something that they were looking at, but not a like a key focus. They definitely reverted a bit back to kind of key priorities and kind of their existing portfolio and kind of managing the current environment. Over the past, I guess, 4 months now, you've definitely seen things go a bit back more to normal in terms of LP conversations. Obviously, having the public markets recover is helpful. The fact that it's not necessarily tied to our underlying economy, is a separate conversation, but in terms of their portfolio values, having them recover is obviously helpful. And I'd say also, given some of the tailwinds over the past 4 months that have been created in this space, just kind of increasing focus around crypto as a potential macro hedge. A lot of certain folks who have come out, like Paul Tudor Jones, for example, who has come out saying he's allocating to to Bitcoin or Bitcoin related investments. Things like that have been very helpful, and just generally, a lot of the technological, tailwinds that you're seeing as well, and that's been good for for certain portfolio companies, and I think also just has brought additional attention to the space and kind of made people say, hey, I need to be, looking at this space if I haven't been already. So that's helped to offset some of the, I guess, some of the, folks who were kind of on hold during part of the pandemic, and generally speaking, we're definitely seeing things recover from that perspective.
Got it. And I guess as part of all of this, what's been your biggest learning, right? As you kind of went out, started Hut Capital, and have kind of gone through the process that you've gone through, what's been the biggest learning that you've had, or maybe the biggest surprise?
Yeah, the biggest learning has definitely been fundraising. So, I was not. I mean, to be clear, I was not responsible for fundraising in my prior prior roles. I was very focused on investing. So, going out and raising a first-time fund as someone who has not fundraised before has been a huge learning experience in terms of like what that process looks like of building relationships, and how long that takes, who you should be talking to, how you go about fundraising, just like who you should, like what are the different what are the different avenues to try to raise capital and find folks that you should be talking to. It's like just the idea of how you fundraise has been like probably massive learning, and there's definitely been mistakes I've made through that process that I've learned, like, okay, maybe I wasn't doing this the right way, and I need to kind of refocus on maybe this part of the market, for example, from a fundraising perspective. And I've definitely adjusted our strategy, since we got started. But yeah, I think people underestimate, like the challenge of raising a first time fund, and it's but just definitely been a big learning.
It always is. Where do you think all of this is going, right? In terms of kind of blockchain venture, does this grow into something that remains kind of a subset of venture? Does it kind of get as big as maybe the way people look at fintech or consumer social or something like that in the venture world? Just where do you think it's going?
Yeah, so I'd say partly that's dependent on your view of the space. I mean, my expectation is that it's, I mean, significantly bigger than fintech, and eventually kind of ends up eating fintech. You know, given my very bullish view on the space in general. But I mean, if you look at it today, you know, you largely have these dedicated funds who are investing in the space, and it's developed very differently than what you've seen in different areas. I mean, you think about, you know, like parts of the market like AI, or, you know, I don't know, marketplaces and like different, you know, other waves of recent technology. You've largely had the dedicated funds come in and, you know, continue to get a lot of the gains and returns, and, you know, continue to do very well with these different ways of technology. And then, you know, there's certainly some dedicated funds that have been in there, but you haven't seen what you see in this space, where, you know, you have this huge number of dedicated funds who are really, you know, the experts in the space. They're where, you know, most of the top founders are going to for capital, and, you know, really kind of being like, you know, where you raise venture money from in this space. So, you know, with that in mind, I do think that is going to continue for the foreseeable future. I've actually been honestly surprised by that you haven't seen traditional venture funds come into this space more aggressively, just, I guess, given my view of it. Although at the same time, you know, if I look back at myself like 3 years ago, you know, it is a big hurdle to kind of say, hey, I'm going to allocate capital into this space for the first time in something I don't fully understand. So I do think that's going to take time, but I think we'll continue to see, you know, a large number of these dedicated funds. You know, the way that these funds invest also is very different than in the traditional world, when you have to worry about things like tokens and, you know, like, are you going to stake your tokens, and a lot of the kind of crypto specific infrastructure that a lot of these generalist funds are definitely just not set up to handle. You know, the expertise is very different, and, you know, if you're not spending your full time in this space, it's really, really, really hard to, you know, really keep up with what's going on, making sure you have the access and relationships to, you know, to be a successful investor. So, you know, there's always going to be exceptions, but I do think you'll continue to see the generalist fund, the dedicated funds thrive, and, you know, be the sought after partners in the space. You know, eventually, I mean, surely you will see the generalist funds spend more time in this space, become more active, and, you know, I think that'll be good for the market overall, because it means, you know, more capital will come in. Yeah, I don't think that's you know, tomorrow, but eventually that will definitely happen, and, you know, I think that'll be good for, you know, good for startups. In terms of how that plays out over time, I think, you know, if you look at the long term, you'll have, you know, a lot of dedicated funds in this space, and I think you'll have a lot of generalist funds who are also investing in the space much more than they are today. But I do think that the dedicated funds, given the unique nature of this space, will, you know, continue to thrive and be a key piece of the market.
Yeah, I love that. Before I wrap up, I ask everyone the same two questions. The first being, what is the most important book that you've ever read?
Hmm, that's a good question. Yeah, I'm not much of a reader. I'm much more of a music person. Um, so I spend much more time listening to music than I do reading. But my most important book I've ever read. Hmm, honestly, not sure. I can't say that there's one that's, you know, particularly influenced me, um, you know, more, you know, like in a profound way, or, you know, more than others in that sense. You know, there's plenty that I've enjoyed, but, you know, generally speaking, I'm much more, you know, much more into listening to music as um, a way to spend my time.
I've never had anyone say that, but that is an awesome answer. The next question is a little bit more fun, which is aliens, believer or non-believer?
I mean, absolutely believe, right? I think just if you think about how massive the universe is, the fact that we exist here, it's just it's incomprehensible to me that there couldn't also be life somewhere else that's evolved. So, I mean, I have to think that there is life somewhere out there in the universe, and probably quite a bit of it. You know, if you think about the massive scope of the universe and how, you know, you could have literally thousands of civilizations and never have one ever make contact with the other. So yeah, I think there has to be life besides us out there.
Tend to think that you're probably right. We'll see, but I tend to think so. To finish up, you get to ask me one question. What's the one question you have for me?
So for your podcast series, how much preparation does it take to get ready for a podcast? Apologies if you've been asked this before, but curious how much preparation goes into it.
So I try to do as little as possible, actually. It's this weird thing. I've talked to other people who have similar types of podcasts. And in the beginning, I would like do all this research and show up. And like, I basically in my head already had like, oh, this is what we're going to talk about. And what happens is it just becomes kind of robotic. And it's kind of like, okay, I'm going to ask this question. I pretty much already know the answer. That's why I'm asking the question. Then I'll ask the next question. And like, it just, I don't know. It was less rewarding for me because I kind of had already done all the work and learned everything before the episode even started. So now, you know, I understand who the guest is, kind of their background. Usually I'll have a couple of talking points, but then I just want to have a conversation and really ask the questions that I'm curious about, right? And kind of just naturally let that play out. And so it's become much more rewarding experience for me to do less preparation. And it seems like there's a couple other people that are kind of in the same boat. And so, I just always remind myself that like, you never want to come unprepared. At the same time, you don't want to show up and have like every single question scripted out. And it's just, you know, like anyone could sit down with a piece of paper and basically fire off the questions and do the recording.
Got it. Yeah, and I have to imagine like the more of these you do, you know, the more you're comfortable not having everything mapped out as well. So that's interesting.
My friends sometimes will be like, hey man, we're not recording a podcast right now. Like, stop asking me so many questions. But like, I'm just trying to learn, just trying to have fun. Right.
Yeah. Nice.
Awesome. Where can we send people to find you on the internet and find out more about Hut Capital?
Yeah, so Hut Capital, you can find us at hutcapital.com. We've also been doing a webinar series featuring leading blockchain VCs, which you can find at hutcapital.com/webinars. You can find me on Twitter at bhpollock, although I'm not super active on there, as well as Hut Capital, which is at hutcap on Twitter. We've also done some writing on Medium, which is at medium.com/@hutcapital. And yeah, that's a good way to find us.
Awesome, man. Well, listen, thank you so much for taking the time to do this. I think that you were leading the way in terms of fund to funds in the blockchain space. So hopefully, more people will come check out what you guys are doing, and we get some more capital into the space.
Yeah, thanks so much, Anthony. A lot of fun, and appreciate you having me on here. So thank you.